Hello and welcome to the second episode of The Index Investor, a series where we address the most frequently asked questions from our viewers about index funds. In today's episode, we'll dive into how to build a strong portfolio using index funds, covering everything from asset allocation to rebalancing and how index funds can work for you. Joining us to discuss these practical strategies is Arun Sundaresan. He's head of ETF at Nippon India Mutual Fund. So stay tuned as we explore the best ways to create a solid, diversified portfolio. Welcome, Mr. Sundaresan.
Thank you, Ruchira. Thanks for having me on the show.
Great to have you back with us. Now, let's start with a question that's on everyone's mind. With so many indices to choose from, Nifty 50, Next 50, Nifty 500, and many others, how should investors decide which index fund is right for their goals?
There are right now nearly 160 indices, unique indices, different indices on which you have products. This is far more high even when compared to the options you have in the active funds, right? So this number itself could be overwhelming. So many funds, and in fact, these are the unique funds. If you look at the total number of funds as of now, it's 560 funds. So that's a whole lot, investors can quite understandably get confused as to where to start. But let me break this up for you. Within these indices, there are only three types of asset classes. So one is equity, second is fixed income, and third is commodities. Commodities, only two commodities are available, which is gold and silver. Now, so the asset class becomes very, very simple. That's the starting point. And within each asset class, in equity also, if you look at it, there are only four types of equity funds at the category level. One is what we call as broad-based indices. So broad-based indices are diversified indices, but these are market cap-based indices, like the popular ones like Nifty, Sensex, mid cap, small cap. The characteristics of these indices, even Next 50 or Sensex Next 30, all of these indices, the characteristics is the sectors will be all diversified. There will be 12 sectors, 15 sectors, but the focus will be on the size of the companies. The larger the size in Nifty will have a higher weight and it will slowly come down. The top 100 is considered to be large cap, then you have mid cap, small cap, etc. So this is one type of index. Everyone understands this, very, very simple. The second category is sector. Like for example, bank, pharma, IT. You have a specific view about a sector at any point in time. Rather than figuring out which bank to buy or which to sell, you simply go and buy the entire index, right? So that's second. The third category is called thematic. Now, thematic is like infrastructure, consumption. This is again diversified, but the theme is very specific. Here, you may be investing into power, construction, some utility companies, but all of them are infrastructure companies, right? So that's a specific theme you want to play, and you can do that with an equity. The last, and this is a very interesting segment within equity, where you again have a plethora of choices, is what is called as factor-based funds or strategy indices. So what these funds do is they focus on specific factors, like for example, value investing or quality stocks, momentum, whichever stocks are having momentum, or those stocks which exhibit low volatility. So you have various of these factors, and then you can even combine them. You can combine two factors. You can combine, let's say, momentum with quality. You can combine alpha with lower volatility, and all of those combinations are possible, right? So these are the four types of equity. Then in fixed income, only two types are there. One is constant maturity. Suppose you want to invest into 10-year government security or 5-year government securities, you can do that. So it becomes straightforward. The other category is called as target maturity fund, which is nothing but almost like an equivalent of FD. So when you're investing right now, you go and invest into, let's say, a 2028 maturing security or a 2030 maturing security, and you will typically buy and hold. So it's as good as you buying a 3-year bond or a 5-year bond. It could be government securities or state loans, or in passives only AAA corporate bonds are allowed right now, the highest grade, right? You just go and buy that, provided there is no default, you're going to get whatever yield you bought till the time you hold on. So at the broader level, these are the three categories, right? And in India, unlike in the Western world, we don't have any exotic passive products like leveraged products or inverse ETFs, and you don't have all that. All the funds have to 100% replicate. So if this understanding becomes clear and becomes very simple, now you're left with the fundamentals of investing. You start with asset allocation, saying how much should I invest into equity, fixed income, and to some extent even in gold and stuff like that. And there is no thumb rule. So how much ever podcast we do, different people talk about it. Some people give thumb rule like 72 minus your age should be this and that, and so many things. Let me tell you, there is no hard and fast rule. There is no thumb rule. See, for example, traditional understanding would be that somebody who's retired will be less risk averse. He should invest mostly in fixed income, if not completely, right? Because his other source of income could have dropped or not there, and then he's dependent on that. So if that is the case, fine. But there could be some retirees who could be very, very wealthy. They may not need that part of the investment corpus for the next 3 years, 5 years, or 10 years. So the purpose could be different. So therefore, I think investors should refrain from general thumb rules. They'll have to think about their unique circumstances. In general, longer the time horizon that somebody has, whether it is closer to retirement or at the time of working, you will invest into slightly more risk assets like equity. For example, I'm a salaried professional, I'm earning, I have net savings month on month. And this money I wouldn't need for the next 5 years, 10 years. This is meant for the longer term. I would predominantly invest that into equity. On the other hand, if I need a regular income, if I'm dependent on that, suppose for whatever purpose, like I'm retired or whatever it is, a larger part should go to fixed income. So investors should think hard about this, and this is a very critical decision point as to how much. There are a lot of studies which shows that asset allocation is what makes, which explains much of your returns. The rest of it, you keep moving here, there, active, passive, all of that will make a difference, but they are not as important as this decision of asset allocation. So you get that right. You decide how much to invest into equity, fixed income. And within that, we talked about various asset classes. And then you can decide. And within equity, generally, again, there is no thumb rule. People have take this approach of core and satellite. The core portfolio they build using market cap, which is broad-based indices, like for example, Nifty, mid cap. So usually a bulk of the equity portfolio will be that. And time to time, as a satellite portfolio, they would add some bit of a sector exposure here or thematic exposure there. Or if they like a particular strategy, they've understood that, they find that it's very interesting, maybe some bit there, etc. But having mentioned about all these things, choices are there. If you break this out into simple terms like this and then start getting into slight details, it's very easy.
Right now, here's another important question. Can index funds be enough to meet long-term goals like retirement or children's education? Or should investors still look to active funds and other products to, round out their strategy?
In my opinion, both. Either you choose to invest 100% in passive or 100% in active or some combination, doesn't matter. It will still help you. As I said, for example, if the question is, suppose you choose only passive and to meet your various goals, including retirement, my sense is it will, because end of the day, what is it doing? It is investing in the market. And here we are talking about investing in any part of the market. If you want to be within equity relatively aggressive, go for mid cap, a little more of mid cap and small cap than large cap, right? Within strategy indices, for example, a strategy like low volatility is far more or far less risky than when compared to momentum, both in terms of risk as well as in return. So within equity, if you want to play it relatively conservative, you could choose a low volatility kind of a product. On the other hand, if you want to be aggressive, then you choose something like a alpha or a momentum. So therefore, within passives itself, there are plenty of strategies, funds to choose from, which will help you meet various investment goals. It could be near term, like 1 year, 3 year. For example, if you say that my goal is for the next 1 year, so we would recommend a 1 year target maturity fund where returns will not be high, but you will have visibility of that return, right? So you can meet that requirement through passive. On the other hand, if you say that, look, I'm 35 or 40, I have 20 more years to retire, it's a very long term. To start with, you invest a lot of money into equity, build that corpus, and then closer to retirement, maybe you reduce that exposure to equity and start adding a little more of fixed income and all that. And while doing it, these are all investments in funds, right? Equity, fixed income. You can also combine this with various modes of investing. For example, you can systematically invest. Instead of investing lump sum every month, you can invest some amount. At the same time, after retirement, or if you want regular income, you can systematically withdraw. We call it SWP, systematic withdrawal plan. You can do that. So by doing a combination of all that, choosing which kind of funds to invest and combining them with various features like SIP, SWP, you can actually, kind of figure out your cash flows as to how exactly you want. So, in my opinion, even in passives, you will be able to build the entire portfolio for various purposes, and even the other way around. So, somebody has a very strong preference for active, so be it. So you can choose, so as I said, that should not be a starting point, active or passive, or how much of active and passive. More importantly, they should go with, they should evaluate each of those strategies for its merit and see, how it fits in.
Right. But Mr. Sundaresan, whatever said and done, we often hear a lot about equity indexing, but not so much about passive debt funds. So while you did mention that there are two kinds of, fixed income passive funds, the one that are constant maturity and then the other ones that are target maturity funds. So if you could elaborate how passive debt funds fit into a well-diversified portfolio.
Okay. So, a debt investing is about investing in bonds, right? So, you can choose different types of bonds, either government securities or bonds issued by state governments. These are called SDL, state development loans,
Mhm.
or you can invest in bonds issued by corporates. And they come in different variety, and depending on the risk and return potential, it could be, having different ratings depending on the risk of that particular bond, like AAA, AA plus, AA, etc. But as of now, in the passive space, only AAA bonds are allowed. So, so this becomes asset class. So within fixed income, suppose you have a very strong inclination, liking to invest only in government securities bond. I do not even want to invest in AAA corporate bonds. You have options. You will have, funds for that, right? So this is one. And then the other important element in fixed income investing is the what we technically call as maturity or duration. Suppose you invest into a 1 year bond and vis-a-vis an investment into a 10-year bond. The movement of the bond, the price movement of the bond based on interest rate movement will be different. Longer the bond, higher will be the risk and return. The interim movement will be. So depending on that, suppose you feel that, okay, I'm investing. I feel that there is an interest rate cut that is going to come that could help my returns. Then you will invest slightly long. You will invest into long dated bonds vis-a-vis short term, and vice versa. You will keep doing that. So this is like, choosing a particular tenure. Like, and at any point in time, the tenure could be more or less that. Like, there is a product called, 8 to 13 year government security ETF index fund. So at any point in time, the investments will be into those securities. You get that constant maturity, right? So this is one. And what you get is a duration impact. You get, you're investing into in this case, a 10-year bond or around that, right? The other type of investing is that it's like you go and buy an FD, right? A 3-year FD in a bank. although that's not the exact right comparison, right? Here you go and buy a 3-year bond. Suppose there is a 3-year Government of India bond, which today is, let's say, trading at, for example, 6.5%, right? Now, if I go and buy this bond today, and this is yielding me 6.5, and government bond will not default, if I hold till 3 years, I will get 6.5, right? So that's the concept. So you go and buy and hold till maturity. And of course, after 1 year or 2 years, if you want to sell, you can sell, but that will be at the market price, depending on how the interest rates are moved. That's a different phenomena. But here is an option for you to actually go and buy a 3-year bond or a 3-year fund. And if you want to stay put for the 3 years, you get more or less that kind of yield. Of course, there'll be some, coupon reinvestment, and, a few things are slightly technical, but by and large, you will get, that kind of this thing. So it becomes very simple, right? So you don't have access to, or generally, a lot of investors will not go and buy bonds directly. Here, you can buy a portfolio of bonds through a passive fund. And in this case, you're targeting a specific maturity, like 3 years. And there are even products for very long term. There is a product for 2036 maturity. Suppose, you want 10 years this thing. Suppose you're approaching your retirement, you're 50 years of age, and by 60 you will retire. So you're targeting a specific corpus between now and the next 10 years with more or less certainty, right? So this money, even though it's long term, you may not want to invest in equity for whatever. You do not want to take that kind of equity risk and say that, look, let me invest into a bond, and this bond is giving me 6.5 or 7. So for 10 years, my money will become double. I'm happy with that, So that's exactly what I'm looking for. And you go and invest there.
Right. Now, lastly, let's talk about rebalancing. So, how often should one adjust a portfolio made entirely out of index funds? And how should one do it manually, or are there automated solutions that can make it easier?
Yeah. See, all index funds by definition are rules based, and as part of the rules, they also have a rebalancing frequency. For example, if you take a momentum index fund, right? So the momentum scores will be checked every 6 months. Every 6 months, and whichever stock is coming in the based on the method, whichever stock is coming into the portfolio, those stocks will come in and the others will go out. The change it keep on happening. So if the concern is that my portfolio should reflect the underlying philosophy, that happens all the time. It happens, it's an ongoing process. It's very, very continuous. So you can be rest assured that I have chosen to invest into a momentum strategy now, and it's going to be like that. And the portfolio automatically does that adjustment over a period of time, right? So same with Nifty and Sensex or anything. Nifty is what? 50 stocks, right? The top 50 stocks. The top 50 stocks are not the same constant all the time. A few stocks will move out, a few stocks will become larger and become the top 50 stocks. So that automatically happens to meet your requirement of investing into top 50 stocks, right? So that part is happening. But the other part, in terms of you making adjustment, that is up to you, and that will depend on your unique requirement. See, for example, to start with, let's say that I'm a very aggressive investor. I wanted to invest 80% in equity, 20% in fixed income. But over a period of time, I'm aging. My requirements are changing. I don't have that many long more number of salaried years or something. So over a period of time, let's say I want to reduce my equity exposure from 80 to, let's say, 60, and get fixed income from 20 to 40. These things you can do by mixing these features that I mentioned, like SWP. So you make a, these things can be automated. You can set this up upfront, saying that, look, today I'm 40. Okay, I'll keep investing. After I reach 50, I want money to move out steadily, systematically from equity to fixed income. I don't have to do anything. Automatically, I'll give this instruction and money will start moving out, so that my targeted maybe 60-40 allocation at that point in time can be achieved. So these kind of solutions can be built with features, and this can be done either automatically you can set this up right now or at any point in time. So you make an investment now and then say that, okay, let me not do anything. At 50, I will review that when I reach 50 years of age. At that point in time, I will redeem or I'll move some money from equity and put that money in fixed income so that my original 80-20 now has become 60-40. So you can do that at any point in time. So I think, that's how you will have to go about it. And again, this is not specific to passive or active. These kind of strategies can be done with any type of investments to meet your various specific objectives.
Right. Well, with that, it's a wrap on today's episode of The Index Investor. A big thank you to Mr. Sundaresan for sharing your insights.
Thank you very much.